Welcome back, folks. I decided to include this little bonus video, and I'm going to put it in a series called Time and Price. Please like, subscribe, show your love, buy me a cup of coffee. So let's get started. Now, this is the trading session from Friday, April 24th. So this was yesterday's session, and today is Saturday morning, just before 8 a.m. when I created this video. And I'm going to be using, which I do often, the 1 minute charts and maybe include some sub 1 minute charts like the 5 second chart, the 15-second chart, and the 30-second chart. And the reason I'm going to start on the 1 minute chart is I'm going to be talking about the macro times. And in this study, I wanted to dig a little deeper into different times, the 30 minute and the 45-minute time. I want to annotate on the chart, and you'll see that here shortly. Because as I start to study price action, I want to know, is there a pattern that happens at certain times of the day, and I can expect a shift in price at certain moments in time. So as I start to dig deeper in the topic and subject of time and price, in this video, I'm going to take a little different look and do some more annotations and study. And if you want to become, and if you already are, a professional trader, which means you trade for a living, or if you're just learning trading and you haven't looked at time and price, I think this will be a good introduction for you to get concepts about. So let's get started. Now, I already have annotations on my chart. Here, I'm looking at the 1 minute chart, and it's a naked chart. I'm just looking purely at price action. And that's what I want to focus on today is the price action and the times where you see swings like this in the chart, like this swing high, like this swing low, etc. Right? Uh, I also introduce in this video uh, a measured Fibonacci after this first pullback, and I'll find out and discover, and you'll discover too, something very important to keep in mind in your trading. So let me put the lipstick back on the charts and put all my annotations where you can see them, and then let's talk about them. Okay, so now you see all the annotations on the chart. Okay, and the annotations are simply all the lines and the rectangles, etc. Time to close the Friday. This is the Friday's settlement price at the end here. Now let me help you understand what you're looking at. The yellow lines represent 15 minutes in price. The blue lines represent the macro times in the price that I was trained on before. So there's macros in the software that's delivering price. Now this is the 1 minute chart. So this looks like they're pretty close. But when we go down to the 15-second charts, they seem to spread out a little differently, but it's still at the same time and price. In other words, this is 45 minutes after the opening bell. Some people teach don't make a trade until after the first 30 minutes in trading. So what would that mean? So that would mean here's the opening bell. at 9:30. So at 10 a.m. here is when you should start to look for, I'm going to make this one green, your first trade setup. Some people teach, look at the prior session's highs, the prior session's lows, and again, this is on the 15-second chart, but price is price. It would look the same on the 1-minute chart. Let me give you an example. Here's your highs of the session, and these dotted lines represent session, so this is the London. You had your London open, go on chart. You had your London open, it took out the Asian high, and then after the London open and taking out the Asian's high, price went after and targeted the Asian's lows, and it took the Asian's lows out right before the New York open. So that's a trade setup you can consider, and that's a tip you'll get for free. Oh, that was wrong. This is Asian and this is London. But anyway, yeah. So we took out this high in the Asian session, and then price came and attacked the lows. Didn't take it out completely, but it did fill this gap of that prior session, and that's important. I'm not going to talk about gaps in this video. I'm going to focus on time and price. And by the way, this blue area here is there for a reason. So the first 45 minutes is the yellow lines. The blue lines are macro times when there should be a shift in price. The green line is the first hour after the opening bell. And some people think, and I was taught, don't make a trade either after the first hour or the first 30 minutes in trading. So in this case, I'm going to look at the first hour and start to identify some things. Well, after the market opened, let's see how price moved. The market gapped open, continued to reach higher, and at 9:42 in this area we see a top price, a temporary swing high, and after 45 minutes we got our first pullback here. When the macro hits, it went after this low and took it out and created our first swing low. A 3-bar reversal. Bar number 1, bar number 2 is a doji, and then we see a breaker structure in the 3rd bar breaking this candle's high. It goes up, it comes back down, and then we created this first presented fair value gap. And why is it the first presented fair value gap? It's the first presented fair value gap because this leg of structure here took out this low. This low right here was taken out. Well, maybe I should use a circle. Let me remove that. Where's that little circle thing at? A comment will work. Or a call out. Let's do a call out. Put a call out right here. And let's get rid of this. And keep the call out. call out right here, this wick right here is sell side liquidity. And thought I put that inside. What happened? Oh, there it is. So this swing low here took out that swing low. Since it took out liquidity here in these two candles, this becomes the first bearish presented for a value gap, but this becomes the first bullish presented fair value gap after this liquidity sweep here. Now, I'm using the first presented bullish fair value gap because we have been in a bullish run for the last few days. I'm going to pop into the 4-hour real quick, reset the chart, and as you can see, we've been in a bullish run for the last few days. So that's why I was paying attention to the first bullish presented fair value gap as opposed to the first bearish fair value gap, if that makes sense. Please like, subscribe, show your love, buy a brother a cup of coffee. I appreciate it. The link's in the description. Now, in this study of time and price, let me reiterate, I'm doing something different. And what I'm doing is measuring two other measurements outside of the macro times. The 45 minutes and the red color represents the 30 minutes in price. And I'm seeing how price moves after each macro. So there's a time of the day where it's good for you to trade. And that's the first hour after the opening bell. Some say the first 30 minutes. You have to decide what's going to fit best for you and your strategy. But I'm trying to give you information that I think would be helpful. For me, I'm looking at how did price move in the first 45 minutes, the first hour? What happened when the macro hit? This first macro drove price down. The green line is the 1 hour. So we have the 30 minutes in price, we have the macro. Now the green line is the first hour since the opening bell. So within that 30-minute time, the macro, we created a first bullish, well, it's really the first bullish fair value gap after the swing low, previous low, and liquidity was swept. That's why the first one's important. The first one's important only after liquidity is being swept. So if it went down, like for example, this, where's another one at? This right here, this little fair value gap, it's not that important because it hasn't taken out the liquidity there. Had this dropped and went lower than this swing low and then printed another fair value gap, that first presented fair value gap after the sweep of liquidity or after stops has been taken out is typically the most important fair value gap to choose. Please, I hope you understood what I'm saying. This one here, I'm going to say it again. This first presented fair value gap, which is bullish, which is a part of the continuous duration trend, is more important than this fair value gap. Why? Because this first presented fair value gap took out the liquidity there. And if you notice in price, price never returned and closed below this first presented fair value gap. For the entire session, price did nothing but move up and move up and move up. And it never took out this high So I'm going to label that external buy side liquidity. That's what this wick represents to me when I see that. And I'm going to lock it in for next week. Now, when price comes and takes this out, if it decides to go back and we get a sell model, I anticipate price to come back into this blue area. When? I don't know. But sometimes in the future, price would begin to fill in because it has not offered sell side in all this uprun. It has not offered sell side other than these little small price movements on the 1 minute chart. And price left a large void of price action between this 9:30 open. It created a opening gap. So now let me get back into time. Again, as I study and created this lesson, the yellow lines are the 45 minutes, the red lines are 30 minutes. So every 30 minutes, I want to go check and see how did price respond to the macro. So here's the price from this time to that time, 45 minutes to 30 minutes. Here's the macro. What happened after the macro? Well, price went down. What happened after the first 30 minutes? Well, price seems to have gone back up. What happened after, the second 45 minutes? Price went down and it continued to go back up. Then this macro hit. Well, price didn't go down. It continued to go back up. What happened after this macro? What time is that? This is the lunchtime macro at 11:50. So price began to trade in a range. It consolidated. After the 11:50 macro, price consolidated. It started to go into a range. And when I study price, I make little annotations on things. And that reminds me, price is consolidating, ranging, wait for a breakout for the best results. Well, we had a breakout here, and that became the extended or external buy side liquidity. So that was a new high. It took out this high. This particular candle, it wicked up. The wick does the damage. It took out this swing high, and then after it takes out that liquidity, it began to go back down into that range. Price did not break out of that range a second time with a lot of strength until, well, we can say there, but that's not much. It pulls right back. But until this macro at 1510, macro seeking liquidity probably took out these little stops. It didn't take out this liquidity, but then it pulls back right back into that range. And for the rest of the afternoon, price pretty much stayed into this range. It popped out a couple of times, but it actually retraced right back into this range. What does that tell you? Well, what it tells me is I should stop trading for the day and not overtrade. Had I had gotten in at the opening bell, waited an hour, discovered the first presented fair value gap, entered to the trade, and then if I were to use a measuring Fibonacci, I would have set my targets. So in time and price, And once you see a first presented fair value gap, you should, Kevin, Dante, Carmelita, Clarissa, are you listening? This is for you. Go to your Fibonacci, grab from those. With after the first presented fair value gap, grab your swing high. Okay, let me do it the other way. Go to your swing low, use the wick to the swing high wick of that price using your measuring Fibonacci. And then look at your measurements. You have one standard deviation, 1.5 standard deviation, and 2 standard deviations, and then you have 3 standard deviations. What does that mean? Well, some people teach that you should always have a 1-to-1 risk reward, right? Let's imagine for a second you use your standard deviations and you wanted a 1-to-2 and you entered here. You would have suffered a little drawdown, but price after the next 45 minutes started to gravitate higher and higher, and you would have targeted your 1-to-2, right? In theory, this is back testing, right? But it helps you to identify times in the market, when to get into the market after the first hour or the first 30 minutes. After you've seen your first pullback, you identify your first presented fair value gap, you entered. If you would identify that, because you're paying attention, you would have entered there. And if you use your measuring tool, you would have got 1 standard deviation, 1.5 standard deviation, 2 standard deviations, and then you have 3 standard deviations. The 2.5 was not plotted. So a 1-to-1 risk reward would have been your first standard deviation. You have 1.5, and then you have 2. And some people teach go for a 1-to-1. Why? Because it's going to be more likely to reach the 1-to-1 than it is to reach the 1-to-2. You can go for 1 to 1.5 standard deviation. That just, it decreases your odds. But in this particular case, it did hit that target. It even hit the 1-to-2 standard deviations. It hit that target here, but you probably wouldn't have got out of the trade until it had closed above that deviation, and you would have been done for the day. Don't overtrade. That's where a lot of people lose. So if you only make 1 or 2 trades during the trading session, that's acceptable. Just come back the next morning, or come back at the open of the next session. After the New York sessions in the morning, you're going to come into the afternoon session during this, after up until 6 p.m. Pacific Standard Time. It's going to be a slower session, which typically stays within a range and doesn't break out much. In my opinion, the best 2 sessions to trade are A, the New York session, and B, the London session. C, the Asian session typically is a session that ranges and doesn't have a lot of momentum or volume or volatility. You can trade it, but you have to, I have a different Fibonacci for trading the Asian session, and I traded the range. I'll sell at the top and buy at the bottom. But oftentimes I don't even waste my time during the Asian sessions. I'll find something else to do and either wait for the New York Open, or if I'm still awake at night, I'll wait for the London Open, and I stay out of the Asian session just because of experience. Now, I'm going to go back and delete some stuff from the chart. I'm going to recap what we discussed. We have the market open. It gapped open from Thursday's settlement price. It gapped higher. It left all this liquidity void, this price void area. There was no price action from here to there. So that tells me eventually the algorithm is going to bring back to this area some actions in price to eliminate this void of price. When will that happen? I don't know. But I know it's there, and I will have to continue to monitor it as the days and weeks go on. And then once this algorithm starts putting us into a sell model, this area will be returned to, revisited, to clear that void in price. We had a 45-minute. We had a 30-minute right here. Where's the first 30 minutes? I should have had a 30-minute candle. Well, it opened up at 9:30, so that's the first 30 minutes, right? The first 30 minutes to 10 o'clock is the first 30 minutes. We start looking for our trade setup, or some people say the first hour. Some people want to wait until 10:30, and that would have been around this area. Well, if you started at 10:30 and you waited a whole hour after the market opened, what do you see? Well, there's a very small, let's see, a very small fair value gap right here. Price touched back into it to clear that void, and then price rejected. Here's another fair value gap. You could have entered at this fair value gap. Once you see this fair value gap present, you wait for the first pullback and you make your entry. We had a break of structure here. We pulled back and price just continued to run higher. That's if you want to wait an hour. Well, what if you want to wait until the first or second algo macro time? Here's the first macro time. You see a bearish fair value gap. But the first bearish fair value gap is right here. Why? Because it took out this liquidity there. And then it reversed. So this would be the first bearish fair value gap. What would be your target? Well, your target would have been this swing low. And once that was taken out, it presented the first bullish fair value gap. So if you were to go trade it within that time and you see this swing high up here with this four clusters, if that was a 2 minute, by the way, it'd be a three candle reversal. See, on the 2 minute, that's a three candle reversal. But on the 1 minute, it looks like a four candle reversal. So as you start getting experience, you'll understand the difference between the time frames and how they present themselves a little differently. But here's your first bearish fair value gap right here. It pulled back into that. You might have got, if you would have put your stop here, you wouldn't have got stopped out. If you had got in here as your first presented bearish fair value gap, your target would be this swing low. That would be your TP target. So that would that be a 1-to-1? What would that be? Let's imagine you got in at this wicks high and you placed your stop above this wicks high in the swing high area. Place your stop a few ticks above that. Your target would have been right here. So that would have been your target, which would be this swing low. So that's like a 1-to-1. right? A little bit better than the 1-to-1. Now watch this. Time and price is always important. You have to decide what strategy that you're going to use. Nobody's going to be able to do that for you. People can share their strategies with you, but if you don't spend time in the charts studying price for yourself, uh, you can stick to someone else's strategy. But my recommendation is that you develop the strategy based on your risk tolerance, the time of day that you can trade, etc. You have to do your due diligence on your own. You can get inspiration and ideas from other people and even use their systems, but just make sure that you understand how their system works. Excuse me, or how their strategy works. Dante, are you taking notes? How about you, Clarissa? Are you listening, Carmelita? Dante, Clarissa, Brandy, all y'all, take the time to learn this because it can bring extra income. This could be your little side hustle, or you can turn it into a business. The choice is yours. But Dante, Carmelita, Clarissa, I love you guys. I want you guys to learn, to grow, to practice, to study to show yourself approved, just like when you meditate in the Bible. You have to spend time in the charts and reading the tape on your own. I just want to give you an insight and hope you stick with it. Hope you continue to watch, like, and subscribe. Support my channel. Buy me a cup of coffee. The link's in the description. I appreciate it. Show your love. And stay tuned for the next video. I don't want to keep you guys any longer than necessary. Go back, rewatch Time and Price. I'm going to include this in my Time and Price series. I'll upload it today. Create a thumbnail for it under the same heading. And go back and watch it. Love you, love you, love ya. Top Down Traders out.